Okay, now last time, I remember we had stopped on elements of financial statements. I think so. This is where we had stopped. This question was once set, and it can come back again. June question to 2016. Actually, the number that we are going to do today, part A was about elements of financial statements, if I'm not mistaken. I think also underlying assumption was there. Did we talk about underlying assumption? Did we talk about underlying assumption, guys?
Yes, we did.
And we said, what is the underlying assumption we have in accounting now?
Going concern.
Going concern, yeah. And we said you have to know the underlying assumption, you have to know what it means, or to explain what it means. And we said going concern means it is an assumption that an entity will remain in operations for a foreseeable future, probably 12 months. So now we said we were going at elements of financial statements. I know some we must have gone through this, but just a recap. We said at times they can ask you for elements of financial statements or components of financial statements. These are two different questions. Elements of financial statements, components of financial statements. We said elements, we have assets, liabilities, equity, we have incomes and expenses. The examiner can tell you to give elements of that are related to financial position, statement of financial position. That is the balance sheet. So there we look at assets, liabilities, and equity. Those related to financial performance, we look at income and expense. I told you have to know how to define each of the elements. And I told you these definitions are never changed. Why? Because they are defined according to the financial reporting conceptual framework. And I told you if a definition is in the conceptual framework, in an accounting standard, or under law, we don't alter anything. So we had gone through and I had highlighted for you the key words in each definition. So now we are looking, and we said components of financial statements. Here we look at different types of financial statements. We talked about statement of financial position, which is a balance sheet. We talked about statement of profit or loss and other comprehensive incomes. This is the income statement. We talked about statement of changes in equity. We talked about statement of cash flows. And lastly, we talked about notes to the financial statement or explanatory notes to the financial statement. Now we are asking ourselves, what do we base on to recognize something, to recognize any element of in the financial statement? What do we base on? What are the parameters that we look at and say that this is an asset, this is a liability? That's what we mean by recognition criteria or recognition of elements of financial statements. What do we base on to categorize this element as an asset, as a liability, as equity, as an income, as an expense? What do we base on? That is called the recognition criteria. Now, these recognition criteria will never change until you finish CPA, because they are embedded in the conceptual framework, the accounting, the financial reporting conceptual framework. Now, let's look at assets. What do we base on to recognize an asset as an asset? There are majorly two, but me, I normally add on a third one. Now, the first one is it has to be probable that future economic benefits will flow to the entity. When I look at my assets, let me say motor vehicle, and I ascertain that it is probable that I will receive revenues, cash inflows as a result of using this motor vehicle, then I have to recognize it as an asset. And the second criteria is the item is cost or the cost of the asset has to be measured reliably. The cost of the asset has to be measured reliably. After this, we shall look at the measurement basis. How do we measure the different elements of financial statements? Measurement normally gives us the value that we have to take to the financial statement, the cost that we have to take with the financial statement. So majorly there are two criteria that we use to recognize assets as assets. One, it has to be probable that future economic benefits will flow to the entity. Two, the cost of the asset has to be measured reliably. This has never been asked, by the way. And thirdly, I normally add on the third one, because some books add on the third one, that the entity has to have control over the asset. The entity must be having control over that particular asset. How about a liability? Liability, it is a vice versa of this. Look at this. A liability is recognized in the balance sheet when it is probable that an outflow of resources embodying economic rights will result from as a result of settling this present obligation. One, for you to recognize a liability as a liability, it has to be probable that there will be an outflow of resources in settlement of this present obligation or liability. An outflow. It has to be probable. I told you in accounting, probable means over 50% chances. Over 50% chances. And the value of that liability has to be measured reliably. If I'm talking about a loan, it has to be probable that I'll be paying this loan, an outflow of resources, and I have to attach a value on this loan reliably, meaning I have to get the true value of that loan. If it's an income, they are giving us, what do we base on to recognize an income? Yeah, an income is recognized in the income statement when an increase in future economic benefit. I think you are relating these recognition criteria to the definitions of this particular element. Some of these criteria come from the definitions of the what? Of this particular element. So if you get to know the definition, you can easily get the recognition criteria of these elements of financial statement. Because here they are saying an income is recognized when there is an increase in future economic benefits relating to an increase in assets or decrease in liability, and it can be measured reliably. So, but mainly, if they ask these questions, it is mainly on assets and liabilities in most cases. What is the recognition criteria of assets, recognition criteria of liabilities? But as well, they can ask you recognition criteria of both incomes and expenses. Of both incomes and expenses. So please, this is a key part which you have to know. There are only 3 points. Probable that future economic benefits will flow to the entity if it's an asset. The cost of this asset has to be measured reliably. The entity must be having control over the asset. As long as those 3 conditions are in existence, please, you have to recognize an asset. Gone are the days when we used to say that when an asset, when you spend 1 million plus on something, you recognize it as an asset. When you buy something and it is to be used over a year, it is a non-current asset. No. The conceptual framework gives us only 3 criteria that we base on to recognize an item as an asset. Guys, are we together? Are we together?
Yes.
Okay. Now let's go to measurement basis. Now measurement means how do we get the figures of assets, of liabilities, of incomes, of expenses that we take to the financial statements. Now normally measurement will work on assets, majorly works on assets. We have 4 measurement bases in financial accounting. When we reach at financial reporting, we shall add on another measurement base to become 5. But at this level, there are 4. This number was set in June 2016, question 2, which we are going to do today. It also came in 2021 March, question 4. The one that came in March was essay. The examiner just wanted you to give the measurement bases and explain them. The one that came in 2016, it was calculations. You have to calculate. Each measurement base has a calculation. The first measurement base is historical cost. Historical cost, it is the same as invoice cost or invoice price or purchase price. This is the cost of an asset that you purchased this asset, whichever year it may be. Maybe 2010, I purchased my building at 500 million. That is the historical cost of the asset. And under this historical cost, the examiner, one, he wants you to know how do we determine cost of the asset. 2, he wants you to know how to determine the carrying amount or the net book value of the asset. Those are 2 major things that he wants you to know. How to determine the cost of the asset, how to determine the carrying amount or net book value of the asset. Now, if it comes to the cost of the asset, how do we determine the cost of the asset? According to IS 16, plant, property, and equipment, it says that the cost of the asset, it is the purchase price of the asset, or what you call the invoice price of the asset, less any trade discounts received. Guys, hope you are writing this. The cost of the asset. Get the purchase price of the asset, less any trade discount received, add any costs incidental. I repeat, add any costs incidental to bringing the asset to its present use and location. Any other costs incidental to bring the asset to its present use and location, minus any refunds, minus any refunds, minus any refunds. What do they mean if when they say plus any costs incidental? Here we are looking at any costs incurred as long as it is directly attributable to this asset. I've bought my car, I shipped my car from Japan, I purchased it, invoice prices 10 million, for example. I have incurred transportation charges or shipping charges to Mombasa. That shipping charge or transportation charge has to be added to the cost of the asset because it is a cost attributable, directly attributable to the purchase of the asset. If I pay import duties at Mombasa, taxes, those taxes have to be added back to the cost of the asset. If I pay transportation from Mombasa to Kampala, that transport has to be added to the cost of the asset. If at all I paid any refundable taxes along the way, that refundable tax has to be less from the cost of the asset. That's why we are saying that arriving at the cost of the asset, get the purchase price, add any costs incidental to bring the asset to its present location and condition, minus any refunds. Now, the examiner will trick you. He will give you different costs, including refundable taxes, including trade discounts, and he wants you to first ascertain the cost of the asset before proceeding to any other calculation. As long as you know that, getting the cost, get purchase cost, less any trade discounts, add any costs incidental, minus any refunds, then you are good to go. Because if you get a wrong cost, of course your workings will be wrong. So that's how we get the cost of the asset. How do we get the net book value of the asset? It is simply cost minus accumulated depreciation. Cost minus accumulated depreciation. Hope you guys are writing. So another measurement base, we have current cost. It is also cost replacement. It is also called replacement cost, and it is also called settlement cost. This is the current amount or cost of that asset in the market today. If I have a Toyota Primo 1998 and I purchased it 30 million 5 years back, that 30 million is the historical cost. But the current cost, I go to the market right now, the cost that I find in the bond that this Toyota Primo making same year is at, let me say, 25 million now. That is what we call the current cost, or the replacement cost, or the settlement cost. Now, under measurement basis, this cost, we don't make any calculation because the examiner will tell you currently in the market, this asset is costing this much. So you just tell him that the current cost is this amount. You just quote the cost that he put in the question because he has told you currently, this is the cost of the asset in the market. So we don't make any calculations if it comes to current cost. We have what we call net realizable value. Net realizable value. Net realizable value, it is simply we get estimated selling price minus estimated costs to sell. Please write it somewhere. Net realizable value, get estimated selling price minus estimated costs to sell. We have lastly the present value. Now the present value, this is the discounted future cash flows, future cash inflows of the asset. For example, the examiner can tell you that ABC Limited purchased a motor van. It is anticipating that in the first year, the van will generate this much. And it also estimates that in the subsequent years, the revenues will decrease by this percentage. ABC Limited normally discounts its cash flows at 20% cost of capital. So we have to discount. If I'm expecting 20 million in 3 years to come, when I'm preparing financial statements, I'll not record 20 million today, this year, but rather I'll record the present value of the 20 million today. Because I'm expecting 20 million in 3 years, so I can't record the 20 million today. I have to discount it to the present so that I get the equivalent of 20 million today. That is called time value of money. So I'm expecting that when the examiner asks the measurement basis, there are 4: historical cost, current cost, net realizable value, and present value. You must know how to explain each of the measurement bases. I told you the question set in March 2021, question 4 was about essay, explaining. The question that was set in 2016 that we are going to look at was calculation. So please, you have to know both how to explain, how to calculate. Guys, are we together? Are we together?
Yes.
Okay. Now let's look at the concept of capital maintenance in determining profit. The concept of capital maintenance in determining profit. The examiner can tell you to explain different concepts of capital maintenance. We have 2 of them. We have financial capital maintenance and physical capital maintenance. And physical capital maintenance. I want to illustrate that. Now, when we come to financial capital maintenance, conceptual framework tells us that some companies determine their profits by looking at the net assets, at the beginning of the year. Net assets brought forward. Let me assume it was 200 million. Then we look at the net assets at end of year, what we call net assets carried down. Let me assume it is 500 million. Now, according to the conceptual framework, the profit for the year made will be 300 million. The increment of the net assets at the beginning of the year and that at the end of the year, the difference, if end of year net assets exceed beginning of year net assets, then we say that we have made a profit by that difference of the net assets. That's what physical financial capital maintenance means. We compare the net assets of the company at end of year and net assets of the company at end of year, then the difference becomes our profit or loss. If it's an increment, it is a profit. If it's a loss, if it's a decrease, then it is a loss. That is embedded in the accounting equation. The accounting equation is assets equals to capital minus liabilities. That is the accounting equation. Now let's look at this logic here. I think it will help us understand more about the financial capital maintenance. Now, how do we get net assets? First ask yourself, how net assets equals to total assets minus total liabilities. That's how we get net assets. But you know very well that when I get my total assets, guys, do you know how a balance sheet looks like? Guys, unmute. It is an interactive session, actually, especially this. Do you know how a balance sheet looks like? A balance sheet, we get total assets minus total liabilities, right?
Total liabilities, yes.
Then total assets minus total liabilities, what do we remain with? What do we remain with?
Net asset. We remain with net asset.
Net asset. No, I'm meaning now the other thing of a balance sheet, because balance sheet, it is assets equals to capital plus liabilities, not so? That is our accounting equation, not so? So when we get our assets and we less our liabilities, what remain with is normal equity, right?
Yes.
Or capital. Because capital, assets equals to capital plus liabilities, not minus liabilities, plus liabilities. So meaning, when I get total assets minus total liabilities, what I remain with is capital or equity.
Capital.
Yes, or equity. At times we call it equity. Yeah? Now, meaning that net assets, it is the same as capital. Are we together?
Yes.
Net assets, it is the same as capital, because net assets equals to total assets minus total liabilities. Equity equals to assets minus liabilities. I remain with equity. Remember we said in the definition of equity, this is the residue interest in the assets of the entity after deducting its liabilities. Okay? When I want to get capital, will equal to assets minus liabilities.
Liabilities.
Yes, because we said equity equals to the residue interest in the assets of the entity minus liabilities. We get the capital or equity. Now, meaning net assets, it is the same as equity. Now, when under financial capital maintenance, when they say that if there is increment in net assets of the company at the beginning of the year to that of the end of the year, then we presume that we've made a profit. They are very right. Because if net assets means equity, if our equity increases, if at all at the beginning of the year I had equity of 200 million, and at end of year, I'm now getting equity of 500 million, it is only one thing that can increase or reduce equity. That is profit for the year. Because when you make profit for the year, you take it to the retained earnings, don't so?
Yes.
And retained earnings is part of equity, right? Guys, are we together?
Yes,
Retained
yes, we are
earnings is
together.
part of capital. Because capital, we look at share capital, we look at share premium, we look at retained earnings. That is capital. So meaning, when our net assets have increased, automatically our profit, we made a profit that year which was taken to the retained earnings. Guys, are we together? That logic? Are you saying that logic?
Yes.
So that's what financial capital maintenance means. But you at this level, you just need to explain it, because they will ask you the concept of capital maintenance. We have financial capital maintenance. How do you explain it? Under this concept, the profit is determined by comparing net assets at the beginning of the year and net assets at the end of the year. When there is an increment, then we presume that the entity has made profits. If there is a decrement, then that is a loss, full stop, and get your marks. You don't need to explain the things of accounting equations. So we have a second one called physical capital maintenance. When we are talking about physical capital maintenance, here we look at the producing capacity of our assets. If at all I had my assets, and at the beginning of the year, my machinery was producing 10,000 units, and at the end of the year, it is now producing 20,000 units. This increment in the production capacity shows a profit made, shows an increment in contribution, thus an increment in profits made. Because the more I produce, the more I sell, and the more I get revenues, right? So, physical capital maintenance, we look at the production capacity of your assets. Then financial capital maintenance, we compare net assets at the beginning of the year and at the end of the year. Any questions so far? Guys, hope we are together. Now this following part, I just put it just to explain more about how do they develop standards in accounting, what process do they go through. So it is not all that important. I just put it just to make you understand more about the conceptual framework. So now they can ask you a question. They can ask you, explain different regulatory frameworks of accountancy in Uganda. What regulates accountancy or the accounting profession in Uganda? That question is set, by the way, and to my surprise, it was set in paper 17, advanced auditing and other assurance services, in December sitting. It was set, but it is on your syllabus, paper 1. It is in paper 1, but it was set in paper 17. I think you can see. What regulates the accountancy profession in Uganda? 1, it is the ISPAL, the Institute of Certified Public Accountants of Uganda. It is number 1 body that regulates accounting in Uganda. 2, we have the Companies Act of Uganda. When you read through the Companies Act, it has different requirements of different categories of companies. The Companies Act of Uganda. We have the Accountants Act of 2013. I'll send it to you. Those who have time, they will go through the Accountants Act of 2013. It shows what does it take for you to become an accountant in Uganda. It shows all disciplinary measures that if an accountant is caught in this, what is the disciplinary measure, including revoking of your practicing certificate. How to run an audit firm. What are the requirements of coming up with an accountancy firm, ABC. So we have also international accounting standards or international financial reporting standards. Those also guide us. They regulate accounting in Uganda. We have also the accounting concepts. Now, the accounting concepts don't change. These are the very ones that you studied at campus and wherever. They don't change. But what changes here, the applicability. Now, when you were studying at campus, some of us, they didn't teach us how do we apply or where do we apply these accounting concepts. Yes, we knew there was going concern, there was the duality concepts, materiality, business entity, money measurement, consistency, prudence, subsistence over form, but they didn't tell us where do we apply these concepts. And these concepts are the same as conversions, they are the same as principles. So please, if they change words, don't get confused. Accounting concepts, accounting principles, accounting conversions, and at times they call them the gaps, generally accepted accounting principles.
Accounting principles.
Yes, these were set in those years. I think you see them. So meaning they can as well come back. We've talked about going concern before. We've talked about it. Then where do we apply going concern? Mainly we apply going concern when we are preparing financial statement, a full set of financial statements. That's why here we are saying when measuring assets, expenses, liabilities. So when we are preparing financial statements, I told you last time that as an accountant, before preparing financial statements, you have to make an assessment of going concern, whether this entity is a going concern, whether it will remain in business in the next 12 months. You have to make an assessment. You have to put assumptions. When an auditor comes, he has to look at the assumptions you used at arriving that your company will be a going concern. He has to look at the reasonableness of those assumptions. The auditor shouldn't assess the going concern of your company, but assess the reasonableness of the assumptions used. Now, if at all your company is not a going concern, the standard says, please prepare your statements on a breakup basis. On a breakup basis, they mean if I'm talking about assets, I might be having a book value of assets of my building as 500 million in my books. The standard says don't put that value, but rather put the market value of the building at the time you prepare the financials at a breakup basis. Okay, now we have matching or accrual concepts. It simply means you have to match revenues and expenses. Match revenues and expenses. That's it, simply means that. We use that in preparing the profit or loss because revenues and expenses, we find them in the profit or loss, right? So we use this concept in the preparation of profit or loss and in accounting for depreciation. When we talk about the prudence concept, it means that accountants shouldn't anticipate any incomes, but rather provide for possible losses. The prudence concept. Prudence concept. As accountants, we don't anticipate any incomes, but rather provide for possible losses. We use this in making provisions, bad debts, warranties, and litigations when valuing assets and stock under IS2 inventories. When we talk about consistency, we are meaning here that as an accountant, we should be consistent year in, year out. If I'm using an accounting policy, let me say depreciation, straight line on my machinery, I should be consistent year in, year out. Unless if I change from straight line to reducing balance, my financial statements will be presented in a more fairly way. And I have to disclose that in the notes of the financial statements, if at all I do change. Substance over form, it means that your business is a separate legal entity, a separate legal person from you, the director. So you have to separate your personal businesses, your personal transactions from the transactions of the business. So historical cost, we've seen it, that all transactions have to be recorded on the historical cost or on the price ruling at the time of the transaction. At the time of the transaction. Business entity, I repeated it. It is the same as substance over form. Business entity is the same as substance over form. We have money measurement. Here we say that all transactions in financial statements have to be recorded in monetary terms, not in kind. Even if you receive something in kind, you have to attach a value. We call it a fair value. You have to attach a fair value on that item in kind so that you can record it in monetary terms. In monetary terms. When you look at realization, we say that revenue is recorded in our financial statements at the time goods are sold, not at the time money is received. As long as you've sold goods and this customer has received them and accepted them, even if he does not pay, you recognize revenue. That is accrual basis. We shall look at accrual basis. We don't recognize when money is received, but when money is earned. When money is earned, earning means I've provided you goods, you have accepted them, I've already earned because I have fulfilled my performance obligation. I have supplied you goods, you've accepted them, so I have earned the money. However much I've not received it, but I've earned it. That is the realization concept. And it is applied when recognizing revenue. Materiality concept means that all transactions that are material have to be recorded in the books of accounts. Have to be recorded in the books of accounts. So where we are going, double entry, I think you see how many times this question has been said. Very many times. So double entry is key. Double entry which simply means journalizing. You have to know how to journal. One of the accounting concepts of which I didn't put here, it is the duality concept or the dual concept. For any debit entry, there has to be a corresponding equal credit entry. So now that is the double entry that we are talking about. You have to know what is a debit. An examiner can ask you, what is a debit? What is a credit? A debit, this is just an accounting entry that either increases assets or expenses, or decreases liability, incomes, or equity account. So that is the definition of a debit. Accounting entry that increases assets or expenses, or either decreases liability, income, or equity. Then a credit, it is the vice versa of a debit. It's the vice versa of a debit. So now you need to know the double entry. Do I have anyone who has no accounting background here? Anyone without any accounting background here?
No.
I think all of you have an accounting background. So I think I'm safe. But in most cases, don't count yourself lucky. The reason as to why I was asking whether there is anyone without any accounting background, normally people without accounting background who study CPA perform well in financial accounting more than you guys who studied accounting. Why? Because these people put in much efforts, because they know they don't know. So they try to put in efforts, especially in double entry. This paper is all about double entry. That's why I was asking, guys, you have to put in much emphasis in double entry. Emphasis. Do you see this table? Are you seeing this table? You need to have this table at your fingertips, and also the definition of debit credit. When assets are increasing, what do? Do we debit? Do we credit? When expenses are increasing, do we debit? Do we credit? When revenues are increasing, you see, you have to be knowing these, guys. This last column, closing balance, this is the normal balancing. This is the normal balancing side of each account. An asset has to be having a normal debit balancing side. Expenses, a normal debit. Revenue, all incomes, credit. Liability, credit. Drawings, debit. Equity, all capital, credit. Please, you have to cram this table as much as you can. You have to cram this table as much as you can. Because where we are going, we are anytime beginning journal entries. When I buy goods, when I purchase, what are the entries? When I sell, what are the entries? What is the entry of return inwards? Return inwards, these are goods that are being returned to the business by customers. You've sold goods to a customer, the customer realizes some goods have defects, some goods are not of the specifications that he requested for, he returns some goods. To us who sold, it is a return inwards. And return inwards reduce the sales. Sales have a normal credit balance. So when I'm reducing sales automatically, I debit. That's why return inwards are debits. Return outwards, these are purchase returns. I have purchased, me as a customer, I realize some goods have defects, I return them. So they are reducing my purchases. Purchases have a normal debit balance. So when I'm reducing purchases, I credit. That's why return outwards have a normal credit balance. Carriage inwards is the same as transportation. When I purchase cement and I incur transport charges, those are carriage inwards. These are expenses on purchases. So it is transport. Transport being an expense, expenses have normal debit balances. That's why carriage inwards, it is a debit. Are we together?
Yes.
We have carriage outwards. Carriage outwards, I have a company, whoever buys in bulk, I give you transportation. This is transport charges incurred on the sales of the business. So that transport that I give my customers who have bought in bulk, it is an expense to me. So it is also a debit. So don't get confused. Both return inwards and return outwards are debits. Guys, are we together? Both of them are debits. Now, some students get confused there. Because both of them, yes, because both of them are expenses. Both of them are expenses depending on who is incurring. One is being incurred by the supplier, one is being incurred by the customer. So both of them are expenses, thus both of them being debit balances. Revenue, we said when we receive money, debit, cash, credit. Revenue or incomes have normal credit balances. Expenses, we said, have normal debit balances. Drawings are expenses. This is cash or goods that are drawn or withdrawn from business by the owners. We call it drawings. It is an expense to the business. Guys, I expect you to come in class next time when you've mastered that table and those transactions. They'll help us a lot where we are going. Trial balance, ledgers, and what. So I sent you a question. I sent you guys a question. Please open up that question. We are going to do that question. Please open up that question. It is June 2016, question 2. June 2016, question 2. Have you seen the question? Guys, have you seen the question?
Yes.
Yeah, I sent it. What are they saying? Part A, the International Accounting Standards Board's conceptual framework for financial reporting presents the underlying assumptions, definition and recognition and measurement bases for elements of financial statements. Explain the underlying assumptions. I told you before we had two assumptions, going concern and depreciation, but right now we have only one, and that is going concern. Depreciation is just an accounting policy. So the examiner expected you to state going concern and define what going concern is. Explain and identify any two elements that measure financial performance and two that measure financial position. We've seen them to the right: assets, liabilities, equity, incomes, expenses. Don't so? Those are elements of financial statements. Part C, I'm interested in Part C. Mafumi Limited acquired a van on 1st January 2013 at a purchase price of 30. Taxes paid were 4, and the estimated useful life was 5 years with a residual value of 2 million. What is that paragraph telling us? What measurement base is that in the first paragraph? Elizabeth? Elizabeth? Ivan? Ivan? Okay, Adams? 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 Hey, these people are not on. Firiam? Firiam? Okay. Infinix, who's using Infinix?
Onesimo Ozala.
Yes, Nelson. What is
Onesimo Ozala.
Onesimo?
Yes.
What is the examiner trying to tell us in paragraph number 1 of Part C? What measurement base is that?
Unfortunately, I did not get the question well.
Now, this number is about measurement bases. We've seen that we have historical cost, current cost, net realizable, and present value. And we said the examiner can set it both in calculation and in essay. Now, this is a calculation number about measurement bases. He's telling you on 1st January 2013, we purchased a motor van worth 30 million. The taxes paid were 4 million, and the estimated useful life was 5 years with a residual value of 2 million. What measurement base is he pointing at?
The measurement basis is
What measurement base is he pointing at? Is it historical cost? Is it present value?
Ivan.
Yes, Ivan.
This is Ivan. The fact that he's looking at the price at which I bought the van.
Yes.
At the beginning of the year, which was 1st January 2013,
yes.
And including the taxes that were paid, with the residual value of, I think, is historical.
Historical cost. Very good. Historical cost.
Yeah.
Now let's look at the second paragraph. Mafumi Limited put a van immediately to use. The estimated net cash inflows amounted to 10 million in 2013, but were expected to reduce by 10% per annum in the subsequent financial years. The cash flows are discounted at 10% per annum. Now that paragraph, second paragraph, what measurement base is he looking at? Elizabeth. Elizabeth, you had put up your hand at first.
I'm still analyzing.
Okay. Cynthia, which measurement base is this?
The present value.
It is what?
The present value.
The present value. Very, very good. Now, immediately the examiner gives you a discounting rate, 10%. Just know that that is a present value. Because we saw that under present value, you have to discount future cash inflows to present value. Not so to present value. Because there is no way you will be reporting for 2021 and you give us a figure of 20 that you anticipate to receive in 2025. So you have to get that figure of 2025, bring it to the equivalent today, then record that figure in your financials today. Are we together?
Yes.
Okay, now let's look at the third paragraph. On 31st December 2015, the management accountant of Mafumi Limited advised that the van be sold and the Costa bus be acquired instead, because the latter would generate higher cash inflows. A professional valuer established that the van could be sold at 17 million. At that stage, the valuer's charges amounted to 1 million and brokerage fees were 1.5. So what is he pointing at? What measurement base is he pointing at? Onesmo. Onesmo, you are still analyzing. Is this Nelson that uses accountant?
Yes, this is Nelson.
Yeah, Nelson, what measurement base is he looking at?
I think this is
It is giving us the estimated value that the bus could be sold at and estimated costs that could be incurred before selling this bus.
this is realizable value.
Very good, net realizable value. Because we said getting net realizable value, get estimated selling cost, selling price minus estimated costs to sell, not so? So I think you see that these numbers are very easy as long as you know how to interpret. Because now for someone who could not identify that each paragraph was a different measurement base, you were to fail. Not so? What he didn't give us here was the current cost. Because I told you current cost, he will normally tell you that currently this van is being sold at 10 million in the market. And I told you with current value, we don't calculate anything. Just get the value he has given you in the question and put it down in the answer that the current value is 10 million, full stop, and get you 1 mark and move on. Okay, now let's begin with, he told us the question, determine the value of the van as of 31st December 2015 if Mafumi Limited uses the following measurement basis. Now the value, he wants us to get the value at which we have to take this asset to the statement of financial position, to the balance sheet, using these different measurement bases. Let's begin with historical cost. We know very well that what we take to the balance sheet as per assets, as per non-current assets, we take net book values. We take carrying amounts. Net book values means I've got my cost minus any accumulated depreciation. What remains is the net book value that I take to the balance sheet. Okay, let's begin. So meaning net book value, at this level, we use much of carrying amount. Yes, net book value or carrying amount equals to cost minus accumulated depreciation. Accumulated depreciation. Now, do we have the cost? Guys, do we have the cost?
Yes.
How much is the cost of this asset?
It's
30 million.
30 million.
Sure. We said what constitutes cost of the asset. We said what is embedded in the cost of the asset.
The purchase price minus a discount, trade discount, plus any cost
incidental to bring this asset to its
Minus.
present location or condition, minus any refunds, right?
Yes.
So now what is the cost of the asset? As per this question, what figure do we take? It's you to give me the figure. Philiam, which figure do we take? Adams. 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 Who is putting up? Who is yes? Yes, Adams. You are putting up the hand. Adams. Adams is putting up the hand, but he's not speaking. Yes, Onesmo.
Yeah, I'm saying the cost of the asset is 34 million because of the taxes paid.
Very good. Because we said any costs incurred to bring the asset to the present location and condition. And I gave you an example of Fatola bought a motor vehicle in Japan, have put in transportation or what we call freight charges. Those charges are added on the cost. If I reach at Mombasa and I pay taxes, the taxes are added onto the cost of the asset. You see, when I want to ascertain the true cost of the asset, it won't be the other 10 million I paid in Japan only, but any costs that have incurred along the way, minus any refundable costs, because any refundable costs, at some extent, they will be refunded to me. That's why I list them. But non-refundable taxes, what I have to add them on the cost of the asset. Guys, are we together?
Yes.
Yes.
Then we less accumulated depreciation. Now, in the question they gave us, the asset was bought on 1st January 2013. But in the required, we are reporting as at 31st December 2015. Are you seeing? Determine the value of the van as at 31st December 2015. Are you seeing?
Yes.
Guys, are you seeing? Meaning, we are calculating accumulated depreciation for 3 years because it was bought on 1st January 2013. 13, 14, 15. They are 3 years, not so?
Yes.
Now, what I will do, I'll first get the depreciation. I'll first get the depreciation for the year. Getting 34 million. 34 million. They gave us residue value. Residue value means scrap value. The amount of money that you could sell this asset when its useful life is done, when its useful life lapses. Are we together?
Yes.
So when I'm to get depreciation, I get the cost of the asset minus the residue value, minus the residue value divided by the useful life of the asset, which is 5 years. Are we together?
Yes.
Now, by getting that, only this bracket, I'm getting depreciation for the year, for 1 year. I'm getting depreciation for 1 year. So if I'm to get depreciation for 3 years, what we call accumulated depreciation, I multiply it by 3. Guys, are we together?
Yes.
Guys, anyone who has not understood this? Under straight line, getting depreciation, get cost minus scrap value over useful life. I get depreciation for 1 year. Remember now, I want accumulated depreciation. Accumulated means I get depreciation for year 1, I add on that of year 2, I add on that of year 3. because under straight line, depreciation for the year is the same throughout the useful life for the year for the machine. So meaning, how much will I get as my net book value? How much will I get as my net book value? The first hand of the brackets, because 32 over 5 times 3. Let me see my calculator. I'm getting 19.2.
Yes.
Then when you less it from 34, we shall get 14.8. Meaning, for someone who has used historical cost, he was to take 14.8 in the balance sheet as the value of the motor van. Are we together?
Yes.
Yeah, for the motor van. Then let's see. For someone, let's first look at net realizable value. Net realizable value. Net realizable value. Now, net realizable value, we said it is simply estimated selling price. It is simply estimated selling price minus estimated cost to sell. Costs to sell. They told us they hired a valuer who estimated that the selling price would be 17 million. This is our estimated selling price. Then he also estimated that before selling, we were to incur 1 million as valuer's fees and 1.5 as brokerage fees. Identifying a customer, we could incur 1.5. So meaning our net realizable value is simply 17 million minus 2.5 million. Then we get 14.5, as easy as that. As easy as that. Guys, are we together?
Yes.
Yeah, these numbers are not hard. These numbers are not hard as long as you've understood the concepts from class. They are not normally hard. So lastly, we have present value. Lastly, we have the present value. Now, present value, we said we have to discount the future anticipated or estimated cash flows to present. He's telling us that it is anticipated that in year 1, we shall have revenues of 10 million in 2013. But these revenues are expected to reduce by 10% per annum in the subsequent years. And you want to discount these cash flows at 10%. Now, here we begin with our years. Years. This is normally taught at level 2 financial management. 2013, we have 2014, we have 2015. We are reporting up to 2015. We have our cash inflows. Cash inflows. How much do we anticipate to get? They are telling us that in 2013, we are anticipating 10 million. In 2013, we are anticipating 10 million. But it's telling us that this revenue is expected to reduce by 10% in the subsequent years. Now, what will be our revenue in 2014? When you reduce 10 million by 10%?
9 million.
9 million. Good. Then what will be our revenue in 2015? when you reduce 9 million by 10%. What will be our revenue in 2015?
8.1.
8.1. Okay. Now, those are anticipated incomes. Remember, cash, these present values, we are dealing with anticipated future cash flows. We just anticipate them. Then we discount them to present. Now, in this particular question, the examiner didn't give us cash outflows. But please, if the examiner gives you cash outflows, you have to come and less them. And less them from cash inflows. Guys, are we together?
Yes.
Because never know in the question they will bring in your year in your city, you may bring cash outflows. So you have to come and less them from the cash inflows so that we can get the net cash flows. Now, in this case, net cash flows will remain the same as our inflows because we didn't have any cash outflows. Okay. In case he gives you cash outflows, please less them from cash inflows so that you can get net cash flows. Which net cash flows we have to discount? Present value factors at 10%. PVF means present value factors at 10%. Now, in this particular question, the examiner gives us a hint. I hope you're seeing that hint below the question. Yeah. Hint that year one, the discounting factor, it is 0.909. Okay. Year two, 0.826. Year three, 0.751. Guys, do you have calculators, scientific calculators?
Yes.
You have?
Yes.
I want to show you something. Then we get the present values. Now, I want to show you something. If at all the examiner does not give you the hint, this hint, because you need these figures to discount, right? If the examiner does not give you the hint and he has not given you financial tables, guys, are we together?
Yes.
How do we get these discounting factors, this hint? How do we get it using your scientific calculators? It's what I want to teach you. Are we ready?
Yes.
Yes, because anything can happen. He can give you a measurement-based present value. He has not given you the hint. He has not given you financial tables, but you have your scientific calculator. Now, you know how we get present value. Let me give you a formula here. Just in financial management, we say present value equals to future value into brackets 1 plus R power 1 plus R then power n. Alternatively, we say present value equals to future value divided by 1 plus R power negative n. Now, how do we get the discounting factor? The discounting factor is simply 1 divided by into brackets 1 plus R power n. So now, are you seeing this last formula? That last formula, it's what we are going to use to get those discounting factors. Now, I want you to get one onto your scientific calculator. Press 1, divide by, open brackets, 1 plus R, in this case is 10%, plus 0.1, plus 0.1, you close brackets. Are we together?
Yes.
Then press OK. What do you get?
$0.909.
Isn't it the one they got in year 1?
Yeah, it's the one 0.909.
Now don't remove that answer. You said divide, you press divide, open brackets. Now repeat the denominator. Repeat this denominator. 1 plus R, we said R is 0.1. 1 plus 0.1, open brackets. Close brackets. Answer divide by 1 plus 0.1, close brackets. Yeah, then press OK. What do you get?
0.826.
Isn't it the one they received? They got?
Is the
Then
one.
from year 2, just press OK now. Just press OK. When you press OK, what do you get?
We got 0.751.
Isn't it what they got in year 3? Press
Is the
OK.
one.
You get in year 4 0.683, right?
Yes.
So as you press, you will be getting different discounting factors in different years. As long as you've done year 1 and year 2, the what other years you just press OK. They just give you those discounting factors. Please, if at all you've not mastered it, please you can ask, because never know. Let me tell you, these guys, anything can happen with these guys. Anything can happen. So don't get go. You just have to learn each and everything that will make you pass. Okay, now getting present values, get 10 million times 0.909, 9 million times 0.826, 8.1 times 0.751. What do we get in the first year? First year, what do you get?
9,090,000.
0.90. And in second year?
$7,434,000.
7,434,000. Okay. And in third year?
$6,083,100.
All right. 6,083 and 100. Okay. Now we get our total present values now. Total present value. Now you will need to add all the 3 for us to get the total present values. Add all the 3 for us to get the total present value. Now that is how we get figures that we take to the balance sheet. This is what we call measurement. Measurement means how we arrive at the figures that we take to the financial statements. We can either use historical cost for assets, or use net realizable value, or use current value, or use present value. How much do we get as total?
Is 22,607,100.
Now, someone asked me a question. I was once in class. That is there a scenario that all these measurement bases can be used in a single period? In a single period? The answer is no. Now, different companies will choose a suitable measurement base to be used on its assets. If they are using historical cost, they will be using historical cost consistently. If they are using net realizable value, they'll use net realizable value consistently. Apart from inventory, now we can use historical cost and net realizable value in 1 year on the same set of financial statements. But net realizable value should only apply on inventory, because that's what the standard says, IS2 inventories. That inventories must be measured at the lower of cost and net realizable value. So we can use historical cost and net realizable value, but particularly net realizable value on inventory, because that's what the standard says. So we look at the present value, and unless if you have a machinery and unless when you have machinery and for you, you decided to use present value on your assets, then you use only that on your set of assets. Apart from inventory, which you use net realizable value. When you decide to use on your machinery and other assets historical cost, please be consistent to that. Apart from inventory, which we use net realizable value. Guys, are we together?
Yes.
Because we've seen one of the accounting principles is consistency. You have to be consistent so as to enable decision making which is reliable enough. Any questions, guys, about measurement bases? Any questions about measurement bases? Allow me introduce the next, just introduction, the next part, the trial balance. Whenever we see now, we begin seeing trial balance. Guys, what comes in our minds? It is correction of errors. It is the accounting cycle, because the accounting cycle begins with the occurrence of a transaction, recording in source documents, transferring to journals. Journals is double entry, I told you already. Then transferring to the ledgers, from journal entries to the ledgers. Then from ledgers, we take balances of each ledger to the trial balance. Then finally, we prepare financial statements from the trial balance. But at times, our trial balance will fail to agree. The trial balance, the total debits have to equal to the total credits. But at times, it will fail to agree. Why? Because of the errors that we might have made in the process of maybe recording transactions, in the process of maybe transferring from journals to ledgers, maybe in additions and subtractions that we've made, maybe in the double entry that we've made. So as a result, we shall have what we call incomplete records or unbalanced records. So what are some of those errors? We are looking at the error of omission. Error of omission occurs when a transaction is completely omitted from the books of accounts. Now, we also have another omission. I've told you the accounting cycle. Occurrence of a transaction, recording in source documents. We have journalizing, transferring to ledgers, transferring to the trial balance. Now, an error of omission can also occur when you are transferring balances from journals to ledgers, or from ledgers to the trial balance. Instead of, if it's, let me say, if it's trade receivables, 10 million, I mistakenly transfer from ledgers to trial balance 1 million instead of 10 million. It means I have omitted the 9 million, right? Yes, that is an error of omission also. So the treatment, when you are correcting errors, the treatment is different from the other error of omission, that this transaction had not been entered completely from in the books of accounts, and this one which had been entered, but in the process of transferring balances, you omit a figure. The treatment, the correction is different, we shall see. We look at error of principle. Here we say a transaction is recorded in a wrong type of account. A revenue expenditure is recorded as a capital expenditure. I've purchased my piece of land. Instead of putting it under capital expenses, I expense it through the profit or loss. That is an error of principle. Wrong type of account. The keyword is wrong type of account. Guys, wrong type. I know my highlight is for a reason. Wrong type. Examiners are looking at specific words. If it's error of commission, a transaction is entered in a wrong personal account. The keyword is wrong personal account. Martha's payment is entered into Mary's payment. Are we together? Wrong personal account. We have complete reversal of entries. A debit is entered as a credit. Complete reversal of entries. A credit is entered as a debit. That is also an error. We're talking about compensating errors. We have another error called compensating errors. I understate my purchases by 2 million. I also understate my sales by 2 million. Purchases have a normal debit balance. Sales have a normal credit balance. I have understated both by 2 million, meaning it is an error, but my trial balance will balance, not so? It will balance very well.
So,
yes? Yes, my trial balance will balance very well because I have understated a debit by 2 and a credit by 2. So, and the effect is 0. So my trial balance will balance, but it is an error. We have error of original entry. This is an error that is made right away from the books, from the source documents, from the source documents. So therefore, you will carry on the error also to the ledgers and to the trial balance. We have transposition errors. I was supposed to enter 2.7 million, but I've entered 7.2 million. I was supposed to enter 2.7, I've entered 7.2. That is an error of transposition. Now, there are some errors that can be revealed by the trial balance and those that cannot be revealed by the trial balance. What do we mean? That when I make an error, my trial balance will not balance, meaning it has now revealed itself that I made an error. And there are those errors that even if I make an error, you won't know. You won't know. They can't be revealed by the trial balance. So you have to be in position because the examiner may ask you errors that can be revealed and errors that can't be revealed by the trial balance. But among all these errors that can be revealed by the trial balance, there are 2. We have errors of transposition can be revealed by the trial balance. Then errors of complete reverse of entries can also be revealed by the trial balance. Can also be revealed by the trial balance. Others may not be revealed by the trial balance. Apart from error of omission, which omission occurred at the stage of transferring balances, then it can be revealed. But this omission that the transaction was not completely entered will never be revealed. But this one, which an omission took place at some stage in the accounting cycle when transferring balances, then it can be revealed by the trial balance. All right. Any questions?
No question, it is clear.
All right. Thanks for your time. Please allow me to stop here for today. No, I'm taking you at the same pace with those of physical class, with those of physical class.
Thank
Yeah. So
you.
we are about now to begin. I think you've seen we've begun calculating numbers. So we are just beginning. Yeah. Thanks for your time and have a good night.
Same to
Good
you.
night.
Hey, have a good night.